Hey, this is Lexi Dobson. I'm in northern Idaho. I just had a question. I've been a realtor for the last 5 years, and I was approached by a couple of friends who are trying to sell some small businesses. Neither of them, any real estate is involved.
Okay.
And both of them, one's a cabinet business that's been established for probably 35 years, family owned, and the other one is a small daycare. And in Idaho, from what my broker said, he's like, yeah, no, you actually can go and list it on the MLS under the commercial department. But I really have no experience, and I'm just trying to get my feet wet on what the right move should be for me to do is. Um, as far as like P&Ls, I looked over those, and I don't even really know what I'm looking at to know how to like comp it out. I've just done tons of like research online, like through Google, but I'm like, what would be, if you were me, what would be your next step?
So I can tell you, first of all, Idaho is a licensed state. So as long as you have a real estate license, which obviously you do, then you can sell businesses there. The, cabinet business, and you said the second one was a daycare. So the first thing I do with business owners is have a conversation and try and get some preliminary information from them on what their timing is. If they tell me, oh, well, I need to sell in the next 90 days or I'm going to close my doors. In general, business sales take on average 8 to 10 months. It doesn't mean they all will, but 90 days, I've, there have been very few transactions that I've closed in less than 90 days. It just doesn't happen very frequently because there's a lot that has to be done to get it prepared for the market, or to prepare the marketing information, put it on the market, process the buyer inquiries and so forth. So, but the first thing we usually do, is get preliminary information from the sellers about the business, and then also let them know that, in order to price a business, we need to figure out what their discretionary earnings is. And so I will send them an email that requests their last 3 years of business tax returns, profit and loss statements, balance sheets, um, an equipment list, which oftentimes your equipment is listed on your depreciation schedule on your federal tax return, so that doesn't necessarily need to be separate. If there's any vehicles included in the sale, then what is the make, model, and mileage, and the year, make, model, mileage. Knowing that the mileage obviously is going to change, but you got to know whether you're dealing with something that's got 20,000 miles on it or 120,000 miles, right? And then based on that, do a little bit of market research, um, and figure out what the discretionary earnings are. So when you're talking about discretionary earnings from a business standpoint, that is, on a small business, it is everything that the seller pays themselves plus all their perks. So they might pay their utilities for their house and their landscape, their gardener for their home and their pool service for their home and all of that. They might pay all those through the business. Well, those are not operating, those are not necessary to operate the business. So what we do to recast is start off with the taxable income on the tax returns and start adding back these things that are not successful for the operation or not necessary for the operation of the business. And then until we come up with a number of what we consider to be their discretionary earnings. So we also add back, the non-cash items. When you've probably heard of EBITDA. So it's earnings before interest, taxes, depreciation, and amortization. So if they have any income taxes, that they've paid, we're going to add those back. We're going to add back the depreciation and amortization if they have any. Oftentimes there's not any amortization on there, but if they do have that, we're going to add that back because it's a non-cash expense. So our goal is to get the tax mitigated number, that is to determine, rather than the tax mitigated value of the business, we want the economic value of the business. And that really comes down to identifying what that discretionary earnings are that's available to the owner. So operating income minus operating expenses is going to give us whatever's left over. And whatever is left over, then we apply a multiple to that to come up with a value. And the multiple that we apply is going to depend on the level of those earnings. Like, for example, if you have discretionary earnings of $52,000, then your multiple is going to be somewhere around 1.5.
Okay.
Whereas if your discretionary earnings is 280,000, now you're looking at a multiple that's probably 2.5 to 3. So the multiple can change depending on the level of discretionary earnings. And then also based on the industry, if you're dealing with like medical device manufacturing, that's going to have a higher multiple because it's just higher. People are willing to pay more for that. If you're selling an IT company or anything that's software as a service, recurring revenue models, those generally have higher multiples associated with them. So that's
Where
really
do I
the
find
first
that
place to
multiple?
start, is because you have to figure out pricing. I'm sorry, you asked what?
Right.
Where do you find multiples?
Yeah, where do I find that multiple?
So first of all, are you a member of IBDA?
No.
Okay. What brokerage are you with?
EXP.
Okay, so if you're with EXP, you have to have a business broker addendum to are you with EXP Realty or EXP Commercial?
EXP Realty.
Okay, so with EXP Realty, you cannot sell businesses, period, because their E&O insurance does not cover it.
Okay.
So
that's what I needed to know.
Yeah, you need to connect with a EXP Commercial person in Idaho, and they need to have a business broker addendum to their independent contractor agreement,
Okay.
so that they can sell businesses, because EXP is kind of they just want to make sure they have. So business sales in general comes with a higher amount of liability than selling real property.
Sure.
Because business is so dynamic and a business can be destroyed overnight.
Right.
So yeah, so in general, and there's also a lot of fraud that can go on in business transactions and things like that. And so EXP wants to make sure that the E&O covers it. And I know on the EXP Realty side, it does not. EXP Commercial, it does, but I believe that's only if you have the addendum to your independent contractor agreement and you've joined the IBDA and taken the courses that they instruct you to take. And
Okay. Yeah, my broker, he said, he's like, in Idaho, I don't believe that you have to do anything different. He said, but he said that an EXP required me to get an attorney involved. And I was like, oh, okay. So I have to get a real estate attorney to then review all documents. That was what he had directed me to do, but I don't know. That's why I
yeah,
was
I
just
mean,
gonna
I would
and
talk.
see.
So if you have questions about that, I would reach out to business brokering at expcommercial.com. I
Okay.
know that there are some people that are trying to, mostly in unlicensed states, because
Mhm.
business sales is only requires a license in 17 states.
Uh-huh.
So in the non-licensed states, I know there are a lot of EXP Realty agents that are selling businesses through their own separate LLCs and things like that, as a
Mhm.
consulting agreement. And I know that there are people, Sean Murphy and, Holly Mayberry and a couple other people who are looking into that and trying to put an end to it. So I
Okay.
would say that, your broker probably needs to check with Sean Murphy on what they're telling you, because
Okay.
I would venture to say that that is
False.
incorrect.
That's okay. Yeah, that's why I wanted to see. I was like, I don't know really what I think about doing it in the beginning anyways, but I just they're all the two people are family friends. They kind of know my family owned a business for a long time. My husband's family owned a business for a long time. Um, so I knew it was gonna take like a year or so, you know. So they're not like in a big rush, but um I just didn't know how to even go about starting to direct them around, you know.
Yeah. Well, I mean, starting is always with the financial analysis to determine pricing.
Yeah.
And that's one of the biggest issues because a lot of times when people are not familiar with how to recast financials and they haven't had any instruction in business brokerage or how to sell businesses, basically they just price it. They just ask the seller. They say, well, how much do you want for it? And
Yeah,
then
and that's
that's
I
how they
kind of did
market it.
that. I kind of did that, but I was thinking, yeah, but that's just not how I work my other business.
Right, exactly. It's like, well, if you did that with houses, if you sell houses or you did
Yeah,
that, if you sell strip malls or office buildings or whatever, if all you ever did was just ask the seller, well, how much do you want for it? And that's how you went priced it.
it would
You,
just, so how do you argue it?
yeah, you
How do
don't,
you stand up for
you wouldn't
it?
sell very much, right? Because
Yeah,
every person, every owner thinks that whatever they're selling is worth more than what the buyers
what
think
it
it's
is.
worth.
Yeah. Well, and then I looked at some businesses that are local that are in the same area on the MLS, and they're really different, but I know kind of what their P&L, I know kind of what they're making, and so I looked at those sheets and kind of compared those, and I thought, okay, that's about the same, but I just don't know if that's strong enough to like price it at, you know?
Yeah.
Okay.
Well,
Well, that
and
was so
also you
helpful.
have to get the tax returns because I can tell you sometimes when you do get the tax returns, what you see between the tax returns and the P&L are two very different pictures.
Well, both the tax returns on them are basically they're making no money. But the P&L, like once I actually break it down from their write-offs and stuff, like they do make money.
Right, but
They've
if
written it so
you,
much stuff off that they're
yeah,
trying to not, make any
uh,
money.
right, but it's not necessarily the deductions that are the problem because, like I said, we start with the taxable income, we start adding things back to bring that number up. Where you run into problems is when you have a business that shows on their P&L that they have $1 million in revenue, and then when you get their tax returns show that there's 600,000 in revenue.
Mm,
You just lost
yeah,
$400,000 of
right.
top line
Yeah.
revenue. So how does that affect your bottom line? I mean, of course, right? So you can look at the P&L and you say, hey, the business is doing really well. It's got 300,000 of profit. And then you look at the tax returns and the tax returns say no profit. And not only is there no profit, but now you're missing $400,000 of gross revenue. And there's just not a lot you can do to solve that particular problem when they're not generating revenue. So,
All right. Well, that answers my question. Thank you so much.